Every satisfying economy you've ever seen collapse in real time. From housing markets to entire currencies, they all follow the same playbook. And that playbook was written in 1929. Today I'm breaking down every major economic crash in modern history, what caused them, who got destroyed, and the warning signs everyone ignored. Starting with the one that started it all, the Great Depression. Here's the thing about the Great Depression, it didn't have to be a depression, it started as a stock market crash. What turned it into a civilizational event was everyone in charge deciding to do absolutely nothing. October 24th, 1929, Black Thursday. Panic selling hits Wall Street and investor confidence evaporates overnight, but the crash itself wasn't the disease, it was the symptom. Throughout the 1920s, regular people were borrowing money to buy stocks with as little as 10% down. Margin debt was exploding. Everyone believed prosperity was permanent, which is, not ideal. When prices fell, margin calls triggered more selling, which triggered more margin calls. The Fed refused to act, the money supply contracted by a third, nearly 25% of American workers had no job. Countries on the gold standard transmitted deflation like a virus. Those that abandoned it early recovered sooner. The warning sign was right there. Explosive margin debt, retail investors piling into stocks they didn't understand, and regulators who refused to tighten the rules. Sound familiar? Because if you think this pattern died in 1929, wait until you hear what happened when oil prices quadrupled overnight. The slow rot. This one's different. Every other crash on this list has a moment, a day you can point to where everything fell apart. Stagflation doesn't give you that. It's a slow creeping rot where your money loses value while you simultaneously lose your job, which is, not ideal. Here's the thing, the prevailing economic models said this was literally impossible. The Phillips curve told economists that inflation and unemployment moved in opposite directions, you get one or the other. But by the mid-1970s, America had both, and nobody in charge had a playbook for it. The 1973 OPEC oil embargo gets blamed as the trigger, but the Fed had already been running loose monetary policy for years, tolerating creeping inflation to keep unemployment low. They thought they could game the trade-off forever. They couldn't. And when inflation started spiraling, the Fed blamed oil prices rather than their own decisions. Meanwhile, a wage price spiral took hold. Workers demanded higher pay, companies passed costs to consumers, consumers demanded higher wages, round and round until expectations of inflation became self-fulfilling. The fix, when it finally came, was brutal. Paul Volcker jacked interest rates above 15%, deliberately inducing a crushing recession to break the psychology of inflation. He chose pain, massive, calculated pain, and it worked. But it took a decade of denial before anyone had the stomach to do what needed doing, but if stagflation was a slow rot from within, the next crisis was a time bomb ticking underneath an entire continent's borrowed prosperity. The Latin American debt crisis. Latin America's lost decade wasn't just about numbers on balance sheets, it was the fallout of a global fix gone wrong. Throughout the 1970s, countries like Mexico, Brazil, and Argentina borrowed heavily from international banks flush with recycled petrodollars. Oil profits pumped back into global finance. The assumption, low interest rates would stick around forever, fueling development and infrastructure projects. But then Paul Volcker stepped in to save the US from inflation by sharply hiking interest rates. That move detonated Latin America's economy overnight. Suddenly, dollar-denominated debts skyrocketed, while commodity exports, oil, copper, coffee, sank in value due to global slowdowns. In August 1982, Mexico defaulted, setting off a domino effect. Brazil, Argentina, and others soon followed, entering painful debt restructuring talks. The IMF's rescue programs came with strings attached, brutal fiscal austerity, slashing government spending to appease creditors, that deepened recessions and unemployment across the continent. In places like Argentina, governments faced hyperinflation while citizens saw their savings evaporate. For most people, years of stagnation or decline in per capita income erased progress made in the 70s. Here's where it gets darker. This crisis gave birth to the modern vulture fund phenomenon, investors snapping up battered sovereign debt at pennies, waiting to cash in on future recoveries. Meanwhile, banks and policymakers had ignored obvious warning signs like soaring debt-to-export ratios, lulled by optimistic growth stories and petrodollar recycling myths. So yes, Volcker tamed American inflation, but somewhere thousands of miles away, millions paid the price for a fix they never asked for. If you thought that was bad, wait until we dive into Black Monday, the market crash that shook the world just a few years later. Black Monday. On October 19th, 1987, the stock market did something mathematically impossible. The Dow Jones fell 22.6% in a single trading day. Not over a week, not over a month. One day. And here's the part that breaks everyone's brain. Nothing was actually wrong with the economy. No recession, no banking crisis. The economy was fine, it just forgot to tell the stock market. So what happened? Computers happened. Specifically, a strategy called portfolio insurance. The idea was simple. Use automated systems to sell futures contracts when prices drop, limiting your losses. Smart, right? Except when everyone runs the same strategy simultaneously, you get a death spiral. Prices fall, computers sell, prices fall more, computers sell more. Rinse and repeat at machine speed until liquidity evaporates entirely. The strategy that was supposed to protect portfolios became worthless because you can't sell into a market where nobody is buying. Leveraged investors got obliterated. Cash-rich contrarians who bought the panic made absolute fortunes within months. The kicker: analysts had warned these mechanical selling strategies could create exactly this feedback loop. Nobody appreciated how many firms had adopted the same approach. Alan Greenspan's Fed flooded the system with liquidity, markets recovered, and the whole thing led directly to circuit breakers, which is basically the market admitting, yeah, we need a pause button now. The biggest single-day crash in history, zero lasting economic damage, sometimes the machines just lose their minds. But if a one-day computer meltdown with no real consequences sounds bad, wait until you hear about a bubble that took an entire country's economy offline for 3 decades. The slow suffocation. Most crashes hit like a car wreck. Japan's hit like a terminal diagnosis. In the late 1980s, Japanese stock prices tripled and land prices doubled. The land beneath Tokyo's Imperial Palace was reportedly worth more than all the real estate in California. Price-to-earnings ratios and land prices relative to rental income were impossible to justify under any growth assumption anyone could dream up. But nobody cared, because Japan had convinced itself that its economic model was unique. The old rules didn't apply here. Land always goes up, which is, a phrase Americans would repeat 17 years later with a straight face. The whole thing ran on loose monetary policy, banks lending aggressively against inflated real estate, and a tax system that actively rewarded holding land. Then Japanese authorities did something almost nobody expected. They deliberately tightened monetary policy to cool the speculation they'd spent years enabling. On February 21, 1990, the Nikkei fell 3%. It never recovered. Not in a year, not in a decade, not in 2 decades. Here's what made Japan different from every other crash on this list. There was no dramatic explosion. Banks had lent against land values that were now falling, so non-performing loans piled up. But regulators let these zombie banks stumble forward, technically insolvent, pretending everything was fine. The result was a slow-motion balance sheet recession, persistent deflation, near-zero growth, failed stimulus after failed stimulus, and public debt accumulating like snow on a roof that never collapses but never gets shoveled either. Japan's lost decade became lost decades. An entire nation's confidence just broke and never came back. But if a slow death sounds bad, wait until you see what happens when an entire region collapses at once, practically overnight. The Asian financial crisis. For decades, East Asia was the golden child of global economics. The Asian miracle, they called it. Thailand, Indonesia, South Korea, Malaysia, all growing at rates that made Western economies look like they were standing still. Here's the thing though. The whole miracle was sitting on top of a ticking bomb. Banks and corporations across the region had borrowed massive amounts in US dollars, short-term loans, while lending domestically in local currencies. As long as exchange rates stayed pegged and stable, this worked fine. Borrowers didn't hedge their currency risk because why would you? The governments got it handled. Then on July 2, 1997, Thailand ran out of foreign reserves trying to defend the baht and was forced to devalue. Because every country in the region had the exact same structural weakness, the contagion spread in weeks. Currencies collapsed by over 50% in some cases. Overnight, the local cost of repaying foreign debt doubled, tripled, became mathematically impossible for some firms. Credit evaporated. Millions lost their jobs. Poverty rates spiked in countries that had spent years pulling people out of poverty. Meanwhile, hedge funds that had shorted these currencies walked away with enormous profits. Distressed asset investors swooped in later, buying corporate assets for pennies on the dollar. The warning signs were all there. Analysts could see the short-term foreign debt piling up, but the miracle narrative was too strong, growth numbers too impressive. Turns out, miracle is just another word for bubble. Nobody's questioned yet, but if currency mismatches could vaporize entire economies overnight, just wait until you see what happens when an entire stock market gets built on companies that have never made a single dollar of profit. The dot-com crash. This is the one everyone says they would have seen coming. A 600% rise in 5 years, companies valued at billions with zero revenue, business models that amounted to get eyeballs now, figure out money later. Obviously a bubble. And yet almost nobody sold. Here's the thing, the internet genuinely was revolutionary. That part wasn't wrong. What was wrong was the assumption that because the technology was transformative, traditional math no longer applied. Profits didn't matter, revenue didn't matter. All that mattered was growth and a domain name ending in .com. And for 5 years, this logic worked perfectly. Every skeptic looked like a dinosaur. Every cautious investor watched their portfolio get obliterated by some company selling dog food online at a loss. The market was rewarding insanity and punishing discipline. So discipline died. Then, starting in March 2000, it just stopped. No single catastrophic event, just a slow realization that maybe a company burning $10 million a month with no path to profitability wasn't worth $3 billion. The Nasdaq fell 78% from peak to trough by October 2002. Every single gain from the bubble era gone. But here's what's interesting. Unlike 2008, the damage stayed mostly contained to investor portfolios and tech workers. Dot-coms ran on venture capital, not bank loans. The banking system survived intact. And the companies that didn't die, Amazon, eBay, they swallowed the market share of 1,000 dead competitors and became empires. Expensive fertilizer, but the internet it overfunded actually grew. The warning sign, a 600% rise built on vibes instead of revenue. Which is, not subtle, but if you think overvalued assets are dangerous, wait until those assets are people's homes, and the entire banking system is built on top of them. The global financial crisis, this is the one. The big crash that defined a generation and turned bailout into a household word. The way it happened is so reckless and dumb, it's borderline impressive, nobody went to jail. Here's how the machine worked. Banks handed out mortgages to people who couldn't afford them. No income checks, adjustable rates that spiked after 2 years, loans bigger than the house. Then they bundled thousands of these junk mortgages into securities, slapped AAA ratings on them, and sold to investors worldwide as safe bets. The thinking was mixing bad loans would somehow erase the risk. Spoiler, it doesn't. The whole system depended on short-term borrowing to fund long-term risky bets. Overnight loans, repos, wholesale markets, everything based on trust. And on September 15, 2008, trust vanished. Lehman Brothers filed for bankruptcy with over $600 billion in assets, America's largest ever. Banks stopped lending to each other overnight. Nobody knew who was toxic or solvent, including themselves. Meanwhile, homeowners went underwater, foreclosures wiped out neighborhoods, and European banks loaded with US mortgage products started collapsing. The crisis went global in a week. Here's where the anger kicks in. A few hedge fund managers who'd warned about the bubble, shorted subprime with credit default swaps, made billions. They saw what everyone ignored. Housing prices divorced from incomes, no doc loans exploding, off-balance sheet risks growing unchecked. The belief housing never crashes. Japan thought that about land too. The contrarians got rich. Banks got bailed out. Executives kept bonuses, regular families lost their homes. But if you think this taught the system a lesson, wait until a tiny virus shows how fast markets can drop in just 10 days. The COVID crash. Every other crash on this list was caused by something inside the financial system: greed, leverage, stupidity, some combination of all three. This one was caused by a virus, and the unprecedented decision to just turn off the global economy all at once. The speed of the collapse was something nobody had ever seen. The S&P 500 triggered its circuit breakers 4 times in 10 days. These things activate when the market drops 7% from the previous close, halting trading for 15 minutes so everyone can collect themselves. 4 times in 10 days. The mechanism designed for once-in-a-generation panic got stress-tested like a fire alarm in a burning building, and the damage wasn't distributed normally. Travel, hospitality, and energy got absolutely gutted, while e-commerce and cloud computing companies basically threw a party. Workers in face-to-face jobs lost everything overnight. Remote workers barely noticed. Small businesses without cash reserves just ceased to exist. Here's where it gets strange. Central banks cut rates to zero, launched massive asset purchases, and governments handed out direct payments and business loans. Markets rebounded with shocking speed. Investors who bought the panic saw some of the fastest recoveries in market history. Meanwhile, the actual economy was still in ruins. The warning signs were there. Elevated valuations, zero pandemic preparedness, despite experts screaming about exactly this scenario for years. But the real question isn't about this crash. It's about the next one. Because every time the system breaks, policy rescues get bigger. And every bigger rescue teaches markets that the floor is always there. That belief might be the most dangerous warning sign of all. If you enjoyed this video,